There's a very definite logic that I believe should be applied when calculating the levels that stop losses should be set at, and also how these stop loss orders are configured to properly manage risk in your trading account. Today I'll be sharing the techniques that I use personally in my trading, and so stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now, or find further links in the description right below. Now back to today's tutorial. I'm a firm believer that it's the price action of the asset that you're trading and sensible logic around that that should define your stop loss levels. Let me show you some of the techniques that I use. The best practice techniques around stop loss management that I'm going to be talking about today are those that I've found most effective at protecting my trading account. And putting this into the context of the trader evolution that we've looked at previously, a stage that usually requires a complete overhaul of a risk management strategy often occurs at the competent trader level. This is where a trader is beginning to get some success, they're building a credible track record, and because of all that learning that has gone on to get them to this particular stage, they now have a realization that they need to tackle risk management head on. And this is often brought about because of an issue with risk management, where maybe drawdowns have been too large, or there's been overdue risk on the trading account up until this point. Now, the most important fundamental principle, I believe, around stop loss levels is that these should be set based on logic and specifically your knowledge of how the price action behaves. And at this stage, there shouldn't be anything else taking part in that calculation, such as position sizing and so on. And I believe that this is often the cause of a major mistake. And I often see traders deciding on what their position size for a trade will be first, and then using that in order to calculate the stop loss level. And this can lead to a number of issues that we'll cover later. Even worse is the trader that simply uses a fixed pip stop loss or a fixed distance from the entry price, because these aren't based on any type of logic and pay no attention to what's happening in the price action. Let me explain this with a conceptual model. So let's use the example of a fixed pip stop loss and show why this makes no sense at all. Let's imagine we're trading a trend continuation pattern. So we'll be waiting for a trend to emerge and then waiting for a retracement from that trend, and so we might enter at a place like this. Now let's first look at the example where this is a particularly large pattern. And so here, if we're using the principle of a 100 pip stop loss, that will be relatively close to the entry point in relation to the size of the pattern. Now, I hope you see the major issue with this. At the point we've set the stop loss here, this is actually a viable level for entering a trade. So even though we've decided to enter on a slightly smaller retracement, this stop loss level represents an alternative entry to this exact type of trade. So this being the case, why on earth would we want to set our stop loss at this level? After all, some of our peers might well be entering their trades at this very point that we'd be exiting. Let's now go to the other end of the spectrum and look at a particularly small pattern. And as long as your trading rules are based on relative values, those same rules could be used to enter this type of pattern as they can the large pattern. So if we're thinking about percentage retracements, this is the equivalent entry point here. And of course, we're hoping that the price will then go upwards and our position will go into profit. And so let's now apply our same rule of 100 pips. But because this pattern is so small, that might result in the stop loss being set here. Now this is a very different situation to the first, but equally damaging to your position. So here your stop loss is set at a level where if it was hit, the viable premise of the system ended way higher than this actual level itself. And as soon as the retracement had hit 100% of the previous impulse wave, which is this level here, the trade no longer remained valid. But even so, our 100 pip rule meant that we were forced to stay in the trade all the way down to here. So this is the absolute opposite of the problem that we saw with the larger pattern. And this is why fixed pip stop losses simply make no sense. So how then do we set our stop loss based on price action? Well, first of all, we want to devise a rule that applies to all sizes of patterns, both big, small and medium. So in terms of the entry, this is identical to the previous two scenarios. And let's just as an example say that we're entering on a 35% retracement. And of course we're hoping that our long position goes into profit from this point. However, as we know in trading, things don't always go the way we want to immediately, and instead the price might fall, let's say to the 50% retracement level. But just like I explained before, this is an absolutely viable retracement pullback to enter into a trend continuation still. And so again, at this point, we would hope that the price would go upwards. But this, of course, on the previous example is where we were setting our stop loss, which didn't make any sense. But equally, price might not rebound at this level either, and might well continue down to an 80% retracement. But this now is beginning to get to the end of this retracement being a viable trade for us. And so although there is a chance that the price will rebound from here, if it goes any lower first, we're probably looking at a reversal of price and not a continuation. And if that's the case, then maybe this is the appropriate place to set our stop loss. So the illustration here shows that at about 90%. And very often, if retracements go beyond 80, they don't turn around and they continue downwards. Or alternatively, you might want to be a little bit more conservative and give it the chance of going to the 100% level in the hope that it would find support there like it did previously and then again continue upwards. And so if we wanted to do that, then we might set our stop level at maybe 110%. So this is what I mean by setting the stop loss level based on logic and the price action. And this should be the first thing that we do when designing our stop loss. However, we do then need to perform the next stage, which is the position sizing of the trade, in order to manage the risk appropriately for our own risk appetite. And I'll be showing you an example of this in the next episode. Now, the example that I've given to you today for trend continuation is only valid for that type of strategy. There are, of course, many other types of strategy, and each will have their own nuances in terms of where the appropriate places for those stop losses are. And so following this next episode, I'm going to have 3 episodes that will look at 3 different types of strategy: mean reversion, breakout, and then we'll go into the trend continuation strategy in a lot more detail than we've had time for in today's episode. So do make sure that you're subscribed to the Darwinex channel so that you get notified when all of those episodes get released. But now until next time, trade safe.